You've spent years building your business, but what happens when it's time to step away? Without the right plan in place, your golden years may not be so golden. What are you doing today to ensure a steady stream of income after you leave the workforce? In today's video, we'll explore how registered retirement savings plans can benefit business owners just like you, and we'll reveal the risks that could derail your long-term goals. Hey there, I'm Gregory Rozdeba, the CEO of Dundas Life. Over the past few years, I've helped hundreds of Canadians make complex financial decisions, including life insurance and retirement planning. When you're running your own business, it's easy to focus on day-to-day challenges and forget about what happens when you retire. You're likely thinking about, should I leave money in my corporation, or is it better to withdraw it and invest personally? We'll break down those options too. So don't forget to smash that like button and subscribe below for more helpful financial planning content. Let's dive in. Entrepreneurs in Canada often wonder what to do with the extra cash in their company while minimizing tax burdens. Essentially, you've got two main options. One option is investing within your corporation. Funds stay within the business, so you won't pay personal income tax right away. Corporate taxes, especially if you qualify for the small business rate, are also lower than personal rates. For example, if your corporation earns active business income under a certain threshold, which varies by province, you might pay a lower tax rate on the income than you would if you withdrew it personally. This money in the corporation can be invested in different assets, like stocks, mutual funds, or real estate. However, keep in mind that the investment income or capital gains generated inside the company might face additional taxes, limiting how much of that profit ends up in your pocket later. The second path involves paying yourself a salary or a bonus and then putting that money into an RRSP. You'll have to pay personal income tax on the salary or bonus right away. However, once the money goes into the RRSP, you can claim a tax deduction. RRSP contributions are capped at 18% of the previous year's earnings, up to a yearly maximum of $32,490 for the 2025 tax year, $33,810 for the 2026 tax year, and around $35,000 for the 2027 tax year. Make sure to check CRA's My Account for the exact annual limits. This deduction lowers the amount of your income that's taxed for that year, an especially helpful strategy if you're currently in a higher tax bracket, because this directly reduces how much you owe in taxes. By keeping your money in an RSP for many years, you let it grow without paying taxes annually on the gains. This tax-deferred benefit can help your contributions multiply faster over time. It's even more useful if you expect to be in a lower tax bracket in retirement, because when you finally withdraw the funds, you might end up paying less tax overall than you would have paid today. Choosing between these two strategies often comes down to weighing immediate corporate tax advantages against the personal tax break of RRSP deductions. Each scenario depends on the numbers, so don't forget to consult with your accountant and financial advisor for personalized guidance. Here at Dundas Life, we aim for transparency and honesty. Reach out to our licensed advisors today to find the strategy that best protects you and your business. So now you might be wondering, is an RRSP the right choice for me? Let's cover the key benefits. 1. Tax-deductible contributions. Every dollar you contribute to your RRSP can be deducted from your taxable income up to your available limit. This means that if your business pays a salary of, say, $100,000 and you contribute $20,000 to your RRSP, your taxable income potentially drops to $80,000. The size of your tax refund or reduction depends on your marginal tax rate. Lowering that taxable income can deliver immediate savings of, say, $8,000 to $10,000 that might be invested elsewhere, perhaps towards corporate growth or personal debt reduction. Deferred tax growth. The beauty of tax deferral is that your investment earnings in an RRSP compound without the annual drag of taxes. Instead of having to peel off a layer for the government each year, your entire principal plus gains keep working for you. Over time, those extra gains can really add up, particularly if you're consistent about making your annual contributions. 3. Retirement savings discipline. Planning for retirement isn't just about setting money aside for one day in the future. It's also about having a reliable financial cushion if life throws you a curveball. Too often, business owners get so caught up in the day-to-day that they forget to secure their long-term well-being. 4. Spousal RRSP for income splitting. Do you have a spouse without an RRSP or company pension plan? In these cases, a spousal RRSP can make a big difference. When you invest in an RRSP under your partner's name, you reduce your own taxable income while still building your family's retirement fund. Come withdrawal time, the income is taxed at your spouse's income tax rate, subject to specific conditions. This strategy can lower the overall family tax burden, especially if you foresee a substantial difference in your incomes during retirement. 5. More investment options. RRSPs can hold a variety of assets: government bonds, corporate bonds, stocks, mutual funds, ETFs, and more. Some people stick to conservative products while others chase higher returns through equities. You can customize your portfolio around your risk tolerance, time horizon, and specific goals. Having multiple choices inside one account means that you can pivot or rebalance as your life situation changes. 6. Home buyer's plan. The idea of withdrawing up to $60,000 tax-free for a first home purchase can be appealing. It's like temporarily borrowing from yourself. You'll eventually need to repay that sum into your RRSP over a set period. But it lets first-time buyers get into the housing market without resorting to high-interest loans. If you combine it with a spousal RRSP, that can be up to $120,000 that you can borrow, or $60,000 each, towards a first home purchase. Though not all entrepreneurs will need this feature, it's a comforting safety net for those looking to settle into home ownership sooner rather than later. The RRSP structure has stood the test of time, offering a regulated avenue for Canadians to save money for the future. Yet no strategy is perfect. Let's explore the possible limitations next. While RRSPs have many benefits, they also carry downsides that might affect your choice, especially if your business income is unpredictable. Let's consider the following. 1. Contribution room limits. Your RRSP contribution room is calculated as 18% of your earned income from the previous year, up to a certain maximum, minus any pension adjustment. This cap might leave high-earning entrepreneurs feeling constrained. If you're generating large business profits, there's a chance you'd prefer to invest more than the allowable threshold. Once you hit that limit, you'll need to consider other options like tax-free savings accounts, or TFSAs, non-registered investments, corporate-held assets, or overfunded whole life insurance. 2. Low-income situations. An RRSP offers its biggest tax benefit when you're in a higher tax bracket now and expect to be in a lower tax bracket in the future upon withdrawal. If your company isn't making much profit yet, or if you're drawing a minimal salary to reinvest in the firm, your tax bracket might be modest. Contributing to an RRSP in these conditions might not produce meaningful short-term benefits. Again, many business owners may prioritize TFSAs or other instruments in this situation. 3. Maximizing contributions. Entrepreneurs sometimes forget how important it is to maximize annual RRSP room or to keep track of unused space that carries forward. Over-contributing beyond a small buffer leads to CRA penalties, while under-contributing might mean missing out on prime years of compounding. Because incomes can vary year to year, keeping an eye on your limits is key to striking the right balance. 4. Tax brackets that shift over time. An RRSP can backfire if you're in a lower tax bracket now, but anticipate moving upward later. It's not a common scenario, but it does happen. For instance, let's say your small business is currently small, so your salary places you in a relatively low tax bracket. Down the road, you expect substantial growth and perhaps a higher bracket. Contributing now might lock you into smaller tax breaks compared to what you'd get if you waited until you were earning more. Likewise, personal and corporate tax rates can change due to legislation, economic shifts, or government changes. Future taxes might look different than today's. Remember that an RRSP's advantage hinges on paying less taxes now and potentially incurring tax at a lower bracket in retirement. These considerations might not be a deal breaker for everyone, but they're worth thinking about if you want the best retirement strategy. Now that we've gone through the benefits and drawbacks of RRSPs, let's take a look at the questions you're probably asking yourself. How do RRSPs compare to simply investing within my corporation? Well, there's no one-size-fits-all answer, because corporate tax rates differ from province to province, and your personal financial details are unique, so it's important to work with an advisor to analyze your complex tax situation. To better understand this, know that federal and provincial governments set combined rates for corporate income. If your earnings qualify for the small business deduction, the rate can be quite good. However, once you exceed that small business threshold, or if your company doesn't qualify, a higher general corporate rate kicks in. This may still be lower than personal tax rates, but keep in mind that when you eventually withdraw funds as dividends or salary, you'll face personal tax too. Now, profits retained in the corporation can be invested in a variety of assets. The challenge is that passive income generated this way is taxed differently, often at higher rates designed to discourage people from using corporations strictly as investment tools. If your passive income surpasses a certain limit, you might lose access to the small business rate for your active earnings. That scenario can escalate your corporate taxes across the board. Luckily, by paying yourself a salary or dividend and parking that amount in an RRSP, you immediately reduce your personal taxable income today. Meanwhile, your RRSP grows without annual tax bills on dividends, interest, or capital gains. Over the years, that compounding can outperform a corporate strategy, particularly if you're subject to the general corporate tax rate rather than the small business rate. The more tax brackets you can sidestep, the more appealing the RRSP becomes. Without a retirement plan, you can find yourself tight for cash when you need it the most. Consider your retirement timeline. Will you need to tap into your savings in 10, 20, or 30 years? If you plan to slow down soon, perhaps leaving funds in the corporation makes sense for immediate flexibility. But if you see yourself working for a while and want to maximize long-term growth, the deferred approach of an RRSP might be more beneficial. Forecasting your future income, potential challenges to tax legislation, and your personal lifestyle plans with your accountant and financial advisor will help you see which path produces the best incomes. Now, take for example two entrepreneurs, Alex and Jordan. Alex decides to keep extra funds in his corporation, invests them, and pays corporate tax on his gains. Later, Alex withdraws those sums as dividends. Jordan takes a salary large enough to max out RRSP contributions, which reduces their annual tax bill. Jordan's RRSP grows without taxes on the investment returns until withdrawals begin in retirement, by which time Jordan might be in a lower tax bracket. In scenarios where the corporation's tax rate is lower, Alex might initially pay less. However, over decades, Jordan could experience a compounding advantage due to the RRSP's tax-deferred nature. The final outcome depends on the difference between personal and corporate rates, the type of investments chosen, and the time horizon. Now, there's a third option which you could explore for managing your profits: permanent life insurance purchased with corporate dollars. This financial tool can offer tax-sheltered growth of cash value, potential creditor protection, and a death benefit that can flow to your estate tax-free, depending on how the policy is structured. Let me explain this a little bit more. Instead of withdrawing money and paying personal tax, you can keep those dollars inside the business and use them to buy a permanent life insurance policy. The cash value inside that product grows, typically with certain tax advantages according to Canadian law. If the person insured by the policy passes away, the payout often goes to the heirs or estate tax-free through the corporation's capital dividend account. If you ever need cash for personal or business reasons, you can borrow against the policy's cash value. The main benefit here is that your cash value continues to grow in value, even while you borrow against it. Note that interest charges will apply, and this approach must be carefully managed, but it can be a strategic way to access funds while still keeping the policy in force. That liquidity can help with business expansion, covering unexpected costs, or achieving personal milestones without fully liquidating your investment. Permanent life insurance often offers protection against claims from creditors, especially if there's a family member named as a beneficiary. For owners in high-risk industries, this can provide peace of mind that certain assets are off limits, even in the event of a lawsuit or business debt. Remember that permanent life insurance can be more complex than simply keeping funds in an RRSP. You'll want to balance out the cost of insurance with the projected investment returns. While it offers unique perks like coverage and tax advantages, it won't automatically be the best fit for every individual. A thorough conversation with an insurance advisor, like one at Dundas Life, is important to align coverage with both personal and corporate planning objectives. It's easy to get overwhelmed by all these possibilities. Here's some extra tips. to help you piece everything together. Each year, consider your tax bracket, corporate profits, and personal financial goals. Don't see RRSP decisions as a one-time choice. Instead, treat them like an annual checkup. Depending on your business that year, you may adjust your RRSP contribution to align with your bracket. Think about whether you're planning to sell your business, experience slower times, or enter a big growth phase. If you expect your personal income to increase over time, you might get bigger tax deductions by making larger RRSP contributions. However, if you think your income might go down soon, it could be smart to contribute more to your RRSP right away, so you can benefit from higher tax savings now. Balancing corporate tax strategies, RRSP rules, and life insurance intricacies can be too much for any busy entrepreneur to handle alone. Working with an accountant or financial advisor, someone who's versed in Canada's small business tax law, can help you avoid costly mistakes. Keep in mind that you'll need to convert your RRSP to a registered retirement income fund, or a RRIF, by the end of the year you turn 71. At that point, minimum annual withdrawals begin, which are fully taxable at your personal income tax rate. If your total retirement income is substantial, these forced withdrawals could push you into a higher tax bracket. Permanent life insurance might be a powerful tool for you, or it might be overkill. Revisit your coverage each year to confirm it still meets your objectives. Some entrepreneurs rely on term life insurance while they build up their capital, and switch to permanent coverage once the company is stable. Others go straight for the permanent solutions for immediate estate planning benefits. Weighing how insurance integrates into your entire framework can reveal new investment opportunities. Today we covered how RRSPs can help you save on taxes, grow your money without yearly tax bills, and add some discipline to your retirement planning, especially if you're juggling a busy business. We compared that approach to leaving funds inside the corporation, which might offer immediate tax advantages, but can involve extra layers of taxation when you finally withdraw. We also looked at permanent life insurance as another option, highlighting how it can shelter retained earnings, offer death benefit, and sometimes provide creditor protection. Still unsure which option is perfect for you? Click the link in the description below to book a call with Dundas Life licensed advisors today. Our team is here to walk you through the numbers, listen to your specific concerns, and design personalized strategies that fit your life goals. If this video has helped you, go ahead and hit that subscription button. Thank you for watching and taking steps towards a better financial future. Stay proactive, stay informed, and let's secure your tomorrow together.